Hello, I'm Hike Chilingarian, co-founder, chairman, and CEO of Delphina Skin, and founder and principal attorney of Chilingarian Law. Our law firm primarily focuses on estate planning, business structuring and succession planning, and tax planning. Today I want to focus on two concepts in taxation: the determination of the basis of an asset and 1031 exchanges, or otherwise known as like-kind exchanges. Many investors, especially those who deal with real estate, have presumably heard about like-kind exchanges. This is a tool that enables them to potentially avoid paying taxes from the sale of an investment real estate and defer the gains to a later time, possibly never. There are certain factors that can make this very attractive planning tool incredibly costly, especially at the most unpredictable time. There are generally three reasons why a 1031 exchange may result in an adverse position for the taxpayer in the long run. General economic conditions, of course, is one of the most obvious factors. Right now, people are dealing with COVID-19 and no one really knows what's going to happen, what the effect on the real estate market is going to be, not just in the long run, but on the particular investment in question. There are also personal financial hardships that a person can suffer in spite of economic conditions. In both of these instances, while the original plan may have been to exchange in unlimited 1031 exchanges for the remainder of the person's life, things don't occasionally turn out as planned. When a 1031 property is sold during the taxpayer's life, management of basis becomes one of the most crucial factors, which is why the first portion of this presentation is devoted to the basics of basis. Now, before we begin the actual material, I do want to mention my background on 1031 exchanges. In 2014, along with two prominent scholars in the legal field, I published an article in Merton's Law of Federal Income Taxation, which is one of the most reputable and prestigious tax treatises and the oldest one in the United States. So without further ado, let's dive into basis. Basis is potentially triggered anytime you're dealing with a capital asset. A capital asset is an asset that is non-perishable and has monetary value. Here are some examples of the types of assets that have basis implications. The big one we will focus on today is real estate, but other examples include possessions such as cars and jewelry, inventory, and for inventory, businesses heavily rely on their ability on taking depreciation deductions, and any gain or loss realized from the sale of inventory. In both of these instances, basis is integral in determining the tax consequences of the business owner. And of course, the other big one are investments, which include securities. For investment assets, capital gain taxes are generally determined by the difference between the basis of the asset and appreciation or loss that the asset had at the time of the sale. There are three factors that are common to real estate that we want to consider when determining the basis in the property. The cost basis is essentially the cost of acquisition that is adjusted to include closing costs, recording fees, legal fees, and other fees. That amount is increased by any improvements the property might have underwent, less any depreciation deductions that were taken. Now, this is not an exhaustive list of the factors that can increase or decrease the basis of an asset, but for our purposes, these are the ones we want to focus on today. The basic terminology used to determine the fluctuation in basis is known as adjusted basis. Let's look at this example. The cost of acquisition of this real estate property is $100,000. The improvements on this property are $80,000 and the depreciation deductions taken are $30,000. This brings the total of our adjusted basis to $150,000 because $100,000 plus $80,000 minus $30,000 is $150,000. Now, why do we care about that? Well, because if the property under this scenario is sold for $200,000, then there would be a $50,000 gain on that property and taxes would be required to be paid on that $50,000 gain. Next, we want to look at the types of property transfers. There are generally four ways that a property exchanges title. That's by gift, inheritance, sale, and exchange. Depending on the method used of the transferred property from one owner to the next, there may be significant tax consequences. One thing I wanted to mention since we're discussing real estate, basis, and capital gains, Section 121 of the Internal Revenue Code allows up to $250,000 of gain to be excluded from the sale of a primary residence by a single taxpayer and $500,000 for a married couple filing their taxes jointly. The property must have been used as a primary residence by the taxpayer for the 2 of the last 5 years prior to its sale. So in this example, the adjusted basis of the buyer is $375,000. The amount realized from the sale is $575,000. That's a $200,000 gain. The property was held for 4 years, so it meets the holding requirement. Because the gain was less than $250,000 and the property was held for more than 2 years during the 5-year period, the $200,000 gain will be excluded from taxation. I mentioned that there are 2 other ways for a property to transfer ownership besides by sale and exchange. When a person receives the property by gift, he inherits the adjusted basis of the person gifting the property. This is known as carryover basis because the adjusted basis of the person gifting the property carries over to the person receiving the property. On the other hand, when a person inherits the property, the person inherits the market value of the property at the time of the decedent's death, which may be more or less than the adjusted basis of the decedent. If the market value is more, the heir will receive a step up in basis, and similarly, if it's less, it will receive a step down in basis. Let's take a look at a couple of examples to see the difference between carryover and step up. So in the carryover example, Greta transfers her interest in an office building to her grandson Sam during her lifetime. Upon Sam's sale of the office building, Greta's adjusted basis is $350,000. The market value and the amount for which the property was sold is $1 million. Sam's adjusted basis is $350,000, which was Greta's adjusted basis, which was carried over to Sam. The capital gain realized on the sale was $650,000. The taxes owed would be 20% of $650,000, which is $130,000. Now, this figure doesn't factor in depreciation recapture, net investment taxes, and assumes that Sam is in the highest tax bracket at the time of the sale. Now, contrast this example with the personal residence Sam inherits because Greta decided to live in her personal residence and pass it on to Sam only after her death. Sam inherits Greta's personal residence after her death. At the time of the inheritance, Greta's adjusted basis was $450,000. The market value at the time of her death was $1 million. Sam's adjusted basis becomes the market value at the time of Greta's death, which is $1 million. If Sam turns around and sells the personal residence for $1 million, he would owe no capital gain taxes because there would be a capital gain of only $0. So with that background in basis, and specifically in adjusted basis, let's discuss some of the basics of 1031 exchanges. A 1031 exchange allows for the taxpayer to not recognize any gain or loss on the exchange of like-kind property. Some important terminology to keep in mind: the relinquished property is the property that is given up in the exchange, and the replacement property is the property that is acquired in the exchange. Now, methods of the exchange include direct swaps, where one property directly is exchanged for another. There's the 3-property rule, where the taxpayer identifies any 3 properties regardless of their value, and the 200% rule, which states that any number of properties can be identified so long as their aggregate value does not exceed 200% of the fair market value of the relinquished property. The taxpayer has 45 days to identify the replacement property and at most 180 days to complete the exchange. Some additional requirements include that it has to be the same taxpayer. And since Tax Cuts and Jobs Act was passed in 2017 and became law in 2018, only real estate properties are allowed to be exchanged under Section 1031. Effectively, what happens in the 1031 exchange is that a gain that would otherwise be required to be recognized from a sale or an exchange is deferred to a later time. There's a potential for a step up in basis. Also, both the relinquished and the replacement properties must meet the qualified purpose requirement, which means that the property given up and the property acquired must be held for productive use in trade or business or investment. There's a safe harbor period of 2 years where the taxpayer must hold the property for a qualified purpose before engaging in the exchange and continue to hold the replacement property for a qualified purpose for 2 years. So let's say that Joe lived in his primary residence for 3 years, then he decides to rent it out for 2 years. Now, he wants to exchange what used to be his primary residence for an office building. He met the qualified purpose requirement for the relinquished property because he rented what used to be his primary residence for 2 years, and he must continue to use the office building for a qualified purpose as well in order to be granted with the non-recognition treatment. One thing that always needs to be considered in a 1031 exchange is boot. Boot is any non-like-kind property, such as other property or cash, that is received in the exchange. In such an event, gain must be recognized, but a loss cannot be recognized. As a general rule of thumb, if the market value of the property purchased is equal or greater to the property that is sold, boot will not be triggered. On the other hand, if it is sold for less, taxes would be owed to the extent of the boot, just like in the example provided in this slide. So in this example, the amount of the relinquished property is $1 million. The amount of the replacement property is $800,000. The taxable boot in this case would be $200,000 because the replacement property is $200,000 less. I want us to look at a hypothetical on a set of exchanges an investor engages in over a span of 2 decades where the original property in the exchange can be traced all the way back to 1988. In 1988, property 1 is purchased by the investor for $85,000. In 1995, property 1 appreciates to $230,000, and in the same year, the investor decides to exchange it for property 2 worth $240,000. In 2003, property 2 appreciates to $400,000. In the same year, property 2 is exchanged for property 3, which is worth $450,000. In 2006, property 3 appreciates to $475,000. Let's take a look at 2 potential outcomes and see the different tax consequences with each one. What happens if the investor decides to sell the property in 2006? Well, under that scenario, because the property is sold for $475,000, the total tax owed would be $71,000. Now, just a quick disclaimer, this is based on a particular hypothetical with a particular set of facts that don't take into account many other factors that can potentially come into play. In an alternate scenario, if the investor dies in 2006 and the heir sells, the total taxes owed could be zero if the heir sells it for $475,000 because the property had a step up in basis at the time of the investor's death. So in one scenario, you have at least a $70,000 tax liability, and in another, potentially no liability. Even if 100 properties were exchanged during the course of the taxpayer's life, the last property will receive a step up in basis at the time of the taxpayer's death. If the property is sold during the life of the taxpayer, the deferred taxes would be owed, including any depreciation recapture. This is why tax planning is an essential tool in maximizing your wealth, whether that is in your annual income taxes, investment decisions, or your business operations. Through proper estate planning, you can also potentially pass on even greater wealth to your future generations. For a more detailed understanding of this topic, please read the article that accompanies this video. I'm Haik Chilingarian, co-founder, chairman, and CEO of Delfina Skin, and founder and principal attorney of Chilingarian Law. Thank you for watching this video.